What is going on, everybody? Welcome back to the Bullish Bears YouTube channel. I am Bullish Bears Kevin, and today we're going to be covering trading terms and lingo. Now, the reason I'm covering this is because a lot of times people will hear me say things like higher highs, higher lows, market order, limit order, all these types of things that some people who are new to the market might not be aware of. So I'm going to make sure that I cover that in this video. I hope you guys enjoy. Please feel free to join our community at bullishbears.com. We have a Discord available as well. Alright guys, let's get into it. So the first thing we're going to cover is order types. BTO is buy to open, that's initiating a new market order position. STC is sell to close, which is exiting an existing long position. BTC, which is buy to close, is exiting an existing short position. STO is sell to open, which is initiating a short market position. Now, a market order is an immediate execution at the best available price. A limit order executes at a specific price or better, and a stop order becomes a market order when a specific price is reached. So these are things we use every single day. We want to know, are we performing a market order, a limit order, or a stop order? Now, usually when we're scalping, we want to be performing market orders, so we're in with the market with the momentum, and we're out with the market with the momentum. A limit order is more when you want to set a trade at a specific price for when price hits a specific level, and then the stop order is to really stop us out of that trade when price comes to this specific level as well. Price movements. So higher highs is peaks surpassing prior high points. Lower highs is when peaks are lower than the previous highs. Higher lows are dips that are higher than the previous low. And lower lows are dips that are failing the previous low as well. An uptrend would consist of having higher highs and higher lows. A downtrend would consist of having lower highs and lower lows. An HOD, which I say quite often in our community, is the high of day. That's when the highest price reached during a market trading day. LOD is the low of day. That's the lowest price reached during the trading day. Volatility measures. So we have the ATR, I mentioned this as well in our community quite often. That's the average true range, and this measures the market volatility and sort of says what the range on that stock or ticker is. A high ATR indicates increased volatility. The VIX is the CBOE Volatility Index, reflecting the market sentiment. A rising VIX suggests rising market uncertainty. NHOD, just like HOD, is a new high reached beyond the current day's high, and NLOD is a new low of day. That's a new low reached during the market's lows. Trend reversals, we look for something like a double top, which is when resistance is tested twice before reversing. A double bottom is when support is tested twice before reversing. Head and shoulders is a bearish reversal pattern. An inverse head and shoulders is a bullish reversal pattern. So now I got two slides coming up for you guys, and this is going to be covering candlestick patterns. The doji is when the open and close are nearly identical. That would be this candle right here. See how we opened at the bottom, we closed at the top. Very similar open and close price, but long wicks on the bottom and the top, right? It's a very even, it's a very unbalanced price. Market cannot choose a direction from here. And an engulfing is when one candle engulfs the previous one, just like we see right here. So you see how this big red candle practically consumes or engulfs the previous candle. The hammer is when there's a small body and a long lower wick. That would be just like this candle right here. And the shooting star is when there's a small body and a long upper wick, right? So this would be a bearish reversal pattern for the shooting star, and a bullish reversal pattern for the hammer. And the reason for that, guys, is these wicks suggest that a lot of either selling pressure came in to push us lower or buying pressure came in to push us higher. Candlestick patterns continued. The morning star is a bullish reversal pattern. That would be this one right here. Usually consists of a red candle. This candle could be red or green, but usually some type of inside candle or, hammer, shooting star, doji, followed by a strong move higher. An evening star is a bearish reversal pattern. That would be this one, and it's practically just an inverse version of this candle, of this candlestick pattern. A bullish harami, would be a small candle within the range of the previous larger candle, just like this one, where it's a small candle within the range of this candle. And a bearish harami would be a small candle within the range of the previous larger candle, but to the bear side. So you see how this was a bullish one because we had a big sell-off, but then we had the bullish harami in this candle, whereas this one is a bearish one because we had a bearish candle within the previous larger green candle. The Fibonacci retracement would be the support and resistance levels using the Fibonacci tool. The key levels for this is 23.6%, 38.2%, 50%, 61.8%, and 78.6%. The Fibonacci is used to identify potential reversals and continuation zones, and it aids in locating entry and exit points. And there are extensions beyond the 100% point, which projects potential price targets as well. RSI and MACD, these are two very common indicators in the market. The RSI is the relative strength index. This measures overbought and oversold conditions. The MACD is the moving average convergence divergence, which indicates momentum shifts and trend. The RSI above 70 signals overbought conditions, and below 30 signals oversold conditions. Some people could adjust these. I know I personally like to make it 80 for overbought and 20 for oversold, so they're really more extreme levels. The MACD crossover indicates potential trend changes, and the signal line crossover confirms MACD momentum. Support and resistance, or as I call them, key levels. Support is a level where buying interest may pause a downtrend. Resistance is a level where selling pressure may pause an uptrend. These levels are crucial for understanding potential price reversals. Traders use support and resistance to make exit and entry decisions. So we might want to target a support zone, we might want to target a resistance zone, or we might want to use these levels to enter the trade in hopes or because there's been history at that level that there has been reversals there. And psychological levels often act as support and resistance as well. So if we're looking at an equity like Apple, we might look for a whole level like 175 even, 180 even, anything by fives or zeros. Breakout and breakdown. A breakout is when price moves above resistance, indicating potential upward momentum. A breakdown is when price drops below support, signaling potential downward momentum. Confirmation of trend change is essential before acting on breakouts and breakdowns, whether you're using an indicator or you're looking at volume. And volume can often accompany a breakout or breakdown, validating the move. If we're seeing a breakout and there's very little volume, there's a good chance it's a fake out. Traders use these signals to enter positions or adjust existing ones. So if I'm already in a trade and my target is a resistance level, but I see we have really good volume going into this level, instead of exiting my trade, I might want to move my stop loss up to really capture more gains on that trade. Trading plan and risk management, as you guys know, in the morning, I will always release my trading plan to our community. A comprehensive trading plan includes entries and exit points, stop losses, and all of that. We want to know exactly how much we're risking on a trade and exactly how much we're potentially gaining on this trade. Risk management involves defining risk as a percentage of capital, just like the 2% rule. We never want to risk more than 2% of our account. A stop loss is predetermined level to limit potential losses. Now we have to respect our stop loss as traders, because a lot of times if the market is moving against us towards our stop loss, we might feel antsy, we might feel the need to move our stop loss. Once we start moving our stop loss, that really sways not only our risk to reward, but we could end up losing a lot more than we initially put in. Take Profit sets a target for locking in profits and managing trades. Alright guys, I hope you guys enjoyed. I hope you guys learned from this. I appreciate you all for tuning in. Have a great day. Happy trading. Don't forget to join our community. Take care.